Hello, and thank you for joining us for this short session on understanding accounts for non-accountants. My name is Paul Samra. I'm partner at Chartered Accountants and Business Advisors, Kingston Smith, specialising in owner-managed businesses and the not-for-profit sector. I hope you find this section interesting. This is one of 3 mini videos on understanding accounts, bite-sized chunks, which I hope you'll find useful. So in part 1, we're going to cover the relevance of accounts, the basis of preparing accounts, and essentially what should a set of company accounts include. So let's crack on. And the relevance of accounts, clearly accounts aren't just produced to keep accountants in work, although some clients do think that. We actually prepare a set of accounts as a means of monitoring performance, comparing one period with another period, assessing and benchmarking performance. HM Revenue and Customs, the tax man, requires sight of every set of accounts, and so we would then forward a set of accounts onto the tax man. Anyone looking to invest in your business is going to be very interested in your accounts and the latest management information. Third parties, maybe suppliers, will be looking at your accounts to see whether or not you are a good for credit, and whether or not your compliance is up to date. For a partnership, well, partners will be able to assess what their profit share is once the accounts have been prepared. And for new and exiting partners, they are able to determine how much is available on their current account if they're exiting to take with them. And also a new prospective partner would again be interested from an investment point of view as to how the partnership has fared. So some very good reasons, compelling reasons, for looking at a set of accounts and for ensuring that accounts are relevant. And now we start to hit a bit of the jargon, but I'll try and make it as painless as I can. The year-end date. Accounts are prepared to a particular date. It might be a year-end, it might be a quarter-end, but it will be an end point. Usually it's the end of the month. So typically in terms of year ends, you'll find quite a few companies with a 31st December year end, maybe 31st of March as well. But you can choose whatever year end you like for your business. You can change your year end as well, a fairly painless exercise. But bear in mind the seasonality of your business and when would be convenient and less stress for accounts to be being prepared in that period, and you can then work back from that. The year-end date is also commonly called the balance sheet date. So the balance sheet date might be 31st December or 31st March or October, and the accounting reference date, again, much the same as the balance sheet date and the year-end date. They are all synonymous, all the same. But if you hear any of those terms, it's just referring to the date to which accounts are being prepared. The accounting reference date, the balance sheet date, or the year-end date. And so we come on to what goes into the public domain. Well, for private limited companies, public limited companies, and community interest companies, all the accounts are put on the company's house file, and anyone can look at your accounts. They can go online, there's no charge, put in the company name, and they will look and see the latest set of accounts, historical set of accounts, details of the directors, of the shareholders, and any other relevant information that is put in the public domain, such as charges that might be levied against particular entities, maybe mortgage, loan, charges put in place. They are registered at Companies House. Charities, registered charities that aren't companies, their accounts are on file with the Charities Commission. And again, anyone can log on to the Charities Commission website, put in the name of the charity, and you'll be able to see the accounts and the relevant information. Private partnerships, they're not for public consumption. The only people that see those accounts are anyone that you decide you want to give the accounts to, plus HMRC. Limited liability partnerships, these are partnerships that have limited liability. They are on Companies House records. They are open for inspection. So quite a lot of information is put on public record for companies and LLPs, and you should be aware of what is going into the public domain. The filing deadline is 9 months. So within 9 months of the year end, balance sheet date, accounting reference date, accounts must be filed. During the COVID pandemic, we've seen that 9 months being extended to 12 months. And then there are fines levied on the company if the accounts have not been filed within the filing deadline. And those fines increase depending on the length of time that has elapsed from the filing deadline. Obviously, companies have limited liability protection. So far as corporation tax is concerned for companies, that is also due 9 months after the year end. So it's quite simple. Have the 9-month rule in your head. You pay your corporation tax and you make sure your accounts are filed with Companies House. Partnerships, a bit different. Unlimited liability, of course, for non-LLPs, and the tax would be due on the 31st of January and 31st of July. So we come on to the basis of preparing accounts. And there are two bases upon which you can prepare a set of accounts. One is a very simple way, very straightforward, and it is the cash basis. The other is more complex, and it's called the accruals basis. Cash basis is very, very straightforward and simple. It is just on the basis of looking at your bank statements, and whatever income you've got, those are effectively your sales, and any expenses that you've got going out of the bank account, those are effectively your purchases and expenses. No account is taken of any debts you might have, any suppliers' invoices that have been on your desk but they haven't been paid. They are not brought into the cash methodology of preparing a set of accounts. And likewise, if you have a lot of customers who owe you money, they won't be reflected in your sales because the money hasn't been received, the money isn't in your bank account, and given that the accounts are being prepared on the basis of what's in your bank account, they won't be included. Cash accounts, cash accounting is rarely seen these days, but obviously from a management accounts point of view, you may well want to knock up a quick set of accounts. Depending on the type of business you're in, you might be a newsagent. Quite a lot of your income is cash, and you rarely have any customers that owe you significant sums of money. There might be paper delivery accounts that are owing, but essentially most of your trade is done on someone coming into your shop, spending money and leaving. So your bank balance would probably be a reasonable estimate of what's come in and what's been spent. So cash accounting for management accounts, quite possible depending on the type of business. But obviously you can manipulate cash accounting. If you choose not to bank money, if you choose not to pay your suppliers, then you're not going to get a very accurate representation of how the business is faring. The accruals basis, on the other hand, is far more sophisticated. And the accruals basis is quite simply looking over and above the bank statements. It looks at what bills you've got that are outstanding and have yet to be paid. And it looks at what your customers, your clients owe you. And it brings in any invoices that have been raised before the year end because they are due to the company, due to the business. So the accruals basis looks past the year end, ignores the year end in many respects, to pick up what hasn't been paid that should be paid and what hasn't been received that should be received, and brings that in. And you can see that when you compare a set of accounts that's prepared on the accruals basis year on year, actually you've got a very sophisticated methodology here whereby you are comparing like with like, and you're actually not at the whim of whether or not you've banked money or paid a supplier, unlike the cash methodology. So the accruals methodology, picking up everything that's occurred in the year, what is due, what is receivable, and bringing that into the accounts. Very important. And then we come on to what a set of company accounts should include. And these company accounts will be prepared on an accruals basis. There will be the director's report. There will be a statement regarding director's responsibilities. There will be an audit report or an alternative accountant's report or an audit exemption statement. Come on to all of these in a moment. The profit and loss account, the balance sheet, cash flow statement, if necessary, and notes to the accounts. We'll deal with some of these in parts 2 and 3, but just let's have a look at the director's report first, and then you'll need to watch Understanding Accounts for Non-Accountants Part 2 to see the rest. So the director's annual report will include details of what activity the company undertakes, depending on the size of the business, an extended business review by the directors, maybe comparing some key performance indicators, indicating what future developments the company may be looking to move into. The director's annual report will also state who the directors are and whether there have been any resignations or appointments during the year. A note of the date of the AGM, the annual general meeting, and of course the director's report will be approved and signed and dated by the directors, along with the other pages in the accounts as necessary. So what we've done in this part 1 is just to cover off what an accounting reference date is, what the balance sheet date is, and looking at the methodology behind a set of accounts to know that you're looking at a set of accounts that has picked up what is receivable and what is payable under the accruals method. And then we've now digging into the accounts, looking at what a set of company accounts includes, and we've touched on here the director's annual report. Part 2 will pick up on balance sheet and profit and loss account in particular, and gives you more information on that. So I hope you found that useful. Thank you for watching, and do look out for Understanding Accounts for Non-Accountants Part 2 and 3.